The reason we use cost of revenue instead of sales, inventory in the books are recorded at cost. So if I compare it to sales, I'm kind of, especially if I'm doing this comparison over the years or across companies, sales, part of sales is cost of revenue. The other part is how much gross margin you have. If two firms are differing quite a bit in their gross margin, then the comparison using sales over inventory is kind of a dirty comparison. And the purpose of something like inventory turnover is to figure out how efficiently you're managing your inventory. Obviously, in airlines, this is not going to matter too much. But if I was doing for, let's say, NVIDIA versus AMD, NVIDIA has a 75% gross margin. That means for each dollar of sales, 75% is profit before all the other expenses. AMD has a gross margin of, I think, 40%, something like that. And I use different terms in different sections. So if you make a comparison using sales, NVIDIA is going to look a lot better, but that's not necessarily because they do a better manage of their inventory. It's because they happen to have higher gross margin. I don't think we have too much inventory issues, but let's check. Let's see. Yeah, for these guys, it's not going to matter much. They have things like fuel and stuff. So let's use that just for the sake of completeness. Let's do it here. Since this involves balance sheet items, it's going to be available only for 2 years. At least using only these 10Ks. For your first homework assignments, I'm going to actually ask you to get balance sheet and income statement items for 5 years. I mean, even though this gives only two, if you go back to 10K for 2022, you can get two more and go from there. Since it's a group work, you guys can divide this stuff between you. So I'm going to take from income statement, let's see, operating revenue. I'm not even sure. They have a cost of goods sold kind of stuff. Well, let's just use that for the hell of it. Since the concept of inventory doesn't apply too much to um, airlines. Let's see, something like that. I'm not even going to calculate this for Southwest Airlines. I just want to show you another way of looking at uh, inventory turnover. This is called days sales in inventory. It's going to drive me crazy. There is no independent information in these measures. Inventory turnover basically tells me how many times on average in a year are you turning your inventory. Day sales in inventory says on average how long, how many days do you keep the inventory. I use 365 because the financial statement I have is for 365 days. If you were using 10Qs, you should use the proper number of days. So, assuming we were going to take this seriously, 65, that, I'm just going to give it a different color. So it doesn't take him too much to turn the inventory. I mean, about 8 days. There are other types of assets for which you can calculate turnover. One of the more important one is receivables turnover, which is basically sales over accounts receivable or days sales in receivables. I'm going to write this explicitly by inverting receivable turnover. And this is also sometimes known as average collection period. So on average, how many days it takes you to collect your receivables from your customers. Let's calculate this directly for both companies. Let me put it somewhere over here. So I'm going to take 365 times accounts receivable divided by total revenue. Turns out it takes them about 20 days. That is not too surprising. These companies do most of their businesses with either credit cards or through intermediaries like Expedia, this and that, or through travel agencies. So it doesn't take them too long to get those. Let's calculate the same thing for Southwest Airlines. 365 times from the balance sheet divided by revenue. You may probably are not too surprised that these are also low. So Southwest Airlines is about a 5-day advantage in getting the receivables a little bit faster, but in the grand scheme of things, it doesn't matter too much. So if I'm the receivables manager of Delta, I'm not worried too much about my job because, roughly speaking, we have the same performance compared to our main competitor. There's a more general uh, number. We're going to look at total asset turnover. This is sales over total assets. We will also look at a number called capital intensity ratio.